Hi guys, this is Terry with Futures.io. It is my honor to welcome back FuturesTrader71 for today's webinar. He is doing a presentation on trading techniques and how they fit into your trading career. This is part of a multi-webinar series focusing on trader education. If you have questions, you can type them into the questions box and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you really enjoy this webinar. Also, please feel free to share, comment, subscribe to our channel. It helps us a lot. Without further delay, I'll hand it over to FT71.
All right.
There we go.
Okay. You should be able to see my screen.
Yep, looks good.
All right. Very cool. Good afternoon, everyone. Thanks for joining in and allowing me to steal a part of your afternoon here. I'm going to start off by saying derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. What you're going to hear about here today is really built on my experience, my opinions. Test it for yourself before applying it to your live account. What we're going to cover, just like Terry said, we're going to be looking at trading techniques. And this is the first of a series. And I don't have the email in front of me of what the series will contain, but the series was built on a survey that was done in March of what followers felt were important topics that needed to be covered. So this is one of 4 main topics. Let's get started. Here's what we'll cover today. First, of course, what is a trading technique? I'm going to go over my history with various techniques. What was my journey? How did I get to where I am now and what I've been using for the last 10 years or so? Does a specific trading technique work better than others? Time frames, the lost piece of the puzzle. Your key task as a trader when it comes to technical trading. How do we convert this knowledge to execution and gains? What is a trading technique? Basically, a trading technique is any organized approach to reading, assessing, and then acting on market activity. This includes buy and hold, dividend reinvestment plans, fundamental analysis, technical analysis of any kind. So that's what a trading technique is. The key is that it is an organized process. It's not some go by your gut kind of see how I feel today type of plan. Most trading techniques use price and volume as the basis of their analysis. I'm going to quickly go over my history, and that's because I know that many, if not most, are not familiar with who I am and how I got here. It gives you a basis from which you can judge how this is applicable to you. I started out as an equity scalper. This was between 2000 and 2002. I was an order flow scalper. Using level 2 access. At the time, it wasn't very common it wasn't very easy to get that kind of access. It required a T1 line, which back then would cost somewhere close to $10,000 a month. So I traded within a group of people. The basic idea of equity scalping, the technique here, is you monitor flow from institutional orders. So institutions go into the market and they use various what are called ECNs, and they put out their demand to buy or sell, their bids and offers. And what we would do is monitor that activity across several stocks, usually 5 or more. Some were trading 10 stocks, and we just hit the space bar to move between among the boxes, the various trading boxes. This was all keyboard-based trading. Very high speed manual trading, not algorithmic. And you look for a continued directional pressure, like there's somebody who's wanting to accumulate Microsoft or JDSU or Cisco or somebody, and you'd see this continuous directional pressure and oversized bids or pressure to sell with oversized orders. And then essentially it was a very, there was a lot of edge there in just buying ahead of institutions and selling back to them as their orders, as their trade desks would move their orders across the market, across prices. This was a very profitable way to trade. It was early on in the electronic trading becoming widely open to speculators, but it was very short-lived. The technique died when the market decimalized. That was, we went from trading in increments of 12.5 cents to increments of 1 penny. Fees increased for SOS orders, for ECN orders, just everything across the board became more expensive, and then 9/11 happened, and the market just went dead. It closed for about, I don't recall, maybe 2 months, and after that it was just difficult for people to put their money in the market, so there was no movement at all. And this technique was highly dependent on discipline and focus. So, things like learning to meditate, learning meditation, making sure you're on a good routine and stuff like that. It was very dependent on your mental state. Then I moved from that to future scalping. I got into a car with the guy who got me into trading, and we drove for 20 hours straight to Chicago, and we secured a position after a few days at a local prop firm that was starting up at the Chicago Board of Trade. So from about 2003, early 2003 through 2005, I was scalping futures, order flow, very heavy. Typical trading day would have a volume of about 1,600 to 3,000 round turns per day, so that's about 1,500 or 3,200 to 6,000 sides per day. Very, very heavy. And this was, again, manual with a mouse, getting in and out of size, scalping around positions. And the main products I traded were the Euro stocks, the FESX, the German DAX, the Bund, and the Dow. The basic idea here, the technique, was the same as equity scalping, except the focus was on indices, exploiting very short-term discrepancies in movement. So we would have ladders, the dome basically, going across the screen, and we would have 6 of them stacked next to each other, and we would simply do a visual arb between different products moving up and down, and we would essentially see that the Dow is starting to get bid and it's taking off. The S&P is still waiting. The NASDAQ has not moved yet, and so based on how the flow is going, you would be able to judge whether or not the move in the Dow should be sold back to where it was, to bring it back in line with the other indices and so on and so forth. This was the basic technique. There was no use of charts, even though we paid for CQG integrated client about $800 or $860 a month. Never used the charts. No analysis. The process was simply coming in the morning, 45 minutes before the open, sitting down, and just kind of warming up with a few small trades, and then the market opens and then off you go. There was no view on analysis. The only thing most of us knew was what numbers were coming out that day. This was a very profitable technique for a while, for about 3 years. It was very profitable. The cost was much lower in futures. The markets were available around the clocks. I felt that there was more action in Europe, that I can come in here Chicago time. I can come in at 2 a.m. and catch the open of the DAX or the Euro stocks and trade there till 4, go to sleep, wake back up for the U.S. Open, and then continue to trade the DAX, Euro stocks, NASDAQ or Dow here and there. And then on bigger numbers, I would go in the bonds every once in a while. This technique essentially died as more volume moved from the pit to the electronic. It became more and more crowded, and also the advent of co-location, high-frequency trading and stuff took over the scalping space. We were competing in a time frame that was really, really small that computers can essentially dominate very easily. Then I moved from futures scalping to futures trading. Well, what happened here is I spent a good part of late 2005 through 2006 just essentially sustaining the scalping technique, but really doing my best to make the transition from scalping to actually trading with market analysis and making stronger, having a stronger hand, being a stronger hand in the market, so that my decisions were built on something of substance. It was a very, very difficult transition. Essentially, you go from printing money every day to having to sit through trades that might sit there and uptick and downtick and go against you for a while, which went exactly against, what was necessary to scalp profitably. So after a while, I was able to justify and hold larger positions using volume profiling, and that's what I use to this day. I discovered that without understanding the auction and how it works, it is really difficult to build any strategy that has any sort of longevity, and that's what I'd like you to take from this. I'd like you to understand that trading technique is important. It is what establishes your edge, but really it is about it is much more than just a trading technique, and that's basically what I see people chasing all the time. What moving average are you using? Which fib are you using? What time frame? All this stuff. And it's important, but it is not what makes you profitable. Futures, by the way, I switched to futures and have stuck with futures because they provided much lower cost. I can control millions of dollars worth of notional value with very, very little in my account. Of course, there's always risk to leverage. But the tax savings, the freedom, overall freedom and stability of the futures market was unmatched in the equities market, and I never looked back at equities. What was my journey in finding what suits me? Here's my journey. I'm moving out of scalping, and I endeavored to basically do every study, every time I found something of interest, being it some sort of a moving average thing, a MACD, RSI, CCI, ATRs. I looked at a lot of stuff, believe me, Gartley's, Drummond Geometry, GAN, all kinds of things, read a lot of books. So after having made pretty good money trading equities, unfortunately I came in at the end of that cycle, and in doing pretty well after about 6 months of struggling in futures, all of a sudden coming in and gaining about 1,000 a day or 600 a day, 1,000 a day, and then all of a sudden that catapulted and it became much, much higher than that, a few $1,000s a day gain, and then bad days were about $2,500, and overall the progress was pretty good. The return on my account was the return on equity on my account was approximately 90% per month, and again, past performance is not indicative of future results, and I'm not telling you that that's what you should be shooting for, but I'm giving you an idea of the magnitude of what was happening at the time. And so moving away from doing that to actually studying, going backwards and studying techniques that would work was a very painful process. But it gave me a very, very complete understanding of what it takes to establish an edge, to establish yourself as a trader, in a career, and that coupled with my experience as a prop shop owner, an operator, and a prop trader, these all came together to help me formulate something that was much more substantive and had much more longevity. Again, that's the purpose of this talk, is to bring your attention to the fact that your trading technique is important, but given what we're going to cover here in a minute, how you process these techniques, how you develop them, how you nurture them, and how you use them is very, very important. So I looked at these averages, but the way I studied things, because I'm an engineer by trade, I didn't just put an average on a chart and just looked back and said, oh wow, look at how it bounces off of a 21 moving average or whatever. What I did is I would export the data into Excel, and I would create the moving average or the RSI or ATR or whatever. I would create it using formulae in Excel so that I understood what affected it, how it worked, what the mathematics were. Then I didn't like that. It seemed, I didn't like using those tools. They seemed to be very laggy, and frankly, they just seemed really deceptive. And that's just my opinion. I'm not saying they are. I just never got good enough with them, I guess. Then I moved into Fibonacci retracements. This made sense to me. The mathematics made sense to me, and I saw a lot of progress there. Then I moved to using fibs with pivots, and I studied candlestick formations and price action. So I'm stacking all of these things, and then with that, I found that over time, pivots were really kind of a self-fulfilling policy, but self-fulfilling premise. But what I felt like I was lacking the whole time is, why does it work sometimes? Why does it not work? How can these bigger players get in right before these big moves? How do they know big moves are about to happen, and so on? And I just happened to discover market profiling. One of the traders I was trading with had attended one of Peter Stadelmeyer's talks and had given me a copy of Stadelmeyer's book. So I looked at market profiling, and that made complete sense to me. The statistical approach to it, the organization of the market into histograms. However, I still felt that it wasn't good enough, because market profiling involved breaking the market down into half-hour increments, but I had much better information. I had volume at price, and on top of that, as I was trading, I would see that on the price ladder on XTrader, on TT, I would see these volume bars forming through the session, and one day I was watching what the market was doing, and what I noticed that day is that the market was in a very very balanced mode, and it just kept moving up and then turning and then moving down and turning and moving up. And what I noticed is that on my TT ladder, it basically had the volume at price, and it kept turning right at the low volume spot where there wasn't much trading happening, and it would push through to the high volume spot, and it would either turn to that low volume spot and break it, or in this particular day it would just push through the high volume spot and then just go to the other low volume spot, and so on. So I started to create these volume profiles, and that became the basis of my analysis. So I did an awful lot of study on that, just exporting volume information, 1-minute data, and creating these volume profiles myself. And then I discovered that they were actually built into CQG's market profile charts, but they were not developed enough, and that's where the whole volume profile revolution kind of started for me. My trading technique in a nutshell, just so you have a frame of reference. My trading technique in a nutshell, I'm a day trader. My time frame is a few minutes to a few hours. I never hold overnight. I use a combination of volume profile charts, multiple studies on rotational behavior. In other words, I look at how the market is pushing up and down, and I look at how those rotations, the characteristic of those rotations when they do happen. What is a normal rotation? What is an excessive rotation? What is a rotation built on news, a news event, and so on and so forth. And then on top of that, I layer statistical probabilities. So I pay a lot of attention. For those of you who are part of Stage 5 Trading or in the chat room, you know that we constantly talk about statistics and you know, how those play out throughout the day. The next step is for me to identify what the auction has done in a higher time frame. So I look at a monthly market profile or volume profile, weekly, daily, and I look at a 15-minute time isn't really a factor. Time just organizes the information. But I'm looking at what has the market done overall. So a simple example of that, as I covered in this morning's Trader Bite, I look at these monthly profiles and I watch for what is the market doing at various phases of its rotations, of its auction. You know, here's what June has done so far. Here's what May has done as a month. You can see that May had a lower high, lower low, and then we ended up breaking higher after multiple days of gaps, things like that. Those are very important pieces of the puzzle for me and create the basis for how I look at the market. Then I break it down into the 15-minute chart. Then I identify areas that where sell or buy rotations will likely test once the market opens. So if the market opens and buyers come in, there's no way for me to predict if it is the buyers that will come in or if it is the sellers that are going to come in. I have no idea. I'm not going to pretend to know. But if they do, here's what they're likely going to accomplish. And for those of you who want more detail on that, the only thing I can offer you is to take a look at the video archive and the webinar series on my website. Next, I look at the Globex session to translate the information that came on the Asian and European session forward into the US session. I create multiple plans. I call these hypotheses, and the reason I call them hypotheses is because I'm looking at this almost like a lab technician. I have an idea of what mixing these two chemicals will be like. Here's my hypothesis. I think the outcome is going to be this. Then you do the experiment and then document or look at what the actual result is. I'm looking at the market because why? Because the market is predictable to a small extent, but overall it has its own nature and there's no way for me to control the outcome. So I look at the market as something that is alive and has free will. So I create these multiple plans to cover different scenarios. I let the day open, the pit session open, and I monitor for who is in control. Once I figure out who's in control or have a decent idea of who's in control, then I look for areas to trade while identifying what the risk parameters are, put on the trade, and let it do its job. That's essentially my approach to the market. If you want to see that happen, free to you, available to you, and there are, I don't know, probably 1,000 videos out there of these trader bites that I do every morning at 9 a.m. Eastern. I invite you to watch them. The URL is right there. Just find me on YouTube, youtube.com, user FuturesTrader71, and you can subscribe to the channel and get notified every time there is a video. These are done live in front of everyone at 9 a.m. Eastern every morning. And during these videos, and go watch today's, for example, during these videos, I essentially show the entire trading technique in an abbreviated way because these videos are intended to be 15 minutes long. I want to cap them to 15 minutes. Again, they're live. People need to prepare for the open. And so between 9 and 9:15, I go over what I'm expecting, what I've seen, what I see, statistics if there are any, and every once in a while it's necessary to remind people of various traps, words of wisdom, things like that. That's all included in there. Again, that is open to everybody. It's a community service thing for me, just as is my website and my webinar series. It's there to help you out if you want it. Does a specific trading technique work better than others? So, for this, we want to ask you to just take a minute here. If you're paying attention, just take a minute and just give us your answer. Does a specific technique, any given technique, work better than others? If you are on an iPad or a smartphone or something and cannot vote, you can go ahead and put that in the chat box. But is any given technique better than another? We're going to close this in 20 seconds. We're approaching a minute, 20 seconds, 15 seconds. We're going to share the results here in 10 seconds, 5 seconds, and only 68 of you have voted. 68% of you have voted. There goes a minute. Okay, I'm going to close this. 70% have voted. That's a pretty good sample out of almost 400 people viewing. Wow, votes are still coming in. All right, I'm going to close this, and here's the result. The result is 48% of you believe that certain trading techniques work than others. Okay, so 48% of you believe so, 25% say no, and the 27% believe that the question is irrelevant or the trading technique is irrelevant. Okay, so back to the show here. My opinion is it is pretty much it's pretty much a no. There are the trading technique, the idea that a trading technique works better than others in a generalistic sense, which is what the question is in my opinion, and it's okay for all of us to have opposing opinions. I'm not trying to contradict yours, but in my opinion, there is no one technique that works better than others. It's like Richard Dennis said in the original Market Wizards. He can take a full ad on the Wall Street Journal or a major journal and put down his trading plan, and most people would lose money at it, even though he's done incredibly well. The turtles traded on his technique and everything else, and that's a fact. That the trading technique, there is no one thing that works better than others. There are people who use moon cycles to trade wheat or grains. There are people who use moving averages versus others who use price action versus others who trade with order flow. The technique is really not that relevant. Why? Because it's highly personalized, and that's the thing I want to really push on you here. Your trading technique has to be incredibly personalized so that you cannot expect to come in, take over someone else's trading technique and expect to do well with it. It's not likely to happen for you. Ultimately, the answer is a particular technique does not work. Working better than another is a no. That there is no one technique that works than another, because your technique is absolutely unique. It's like asking, is my first son better than my second son? You know, they're different. Every one of them is different, and that's what you need to be aware of. That you have to ultimately, as a trader, develop your own approach. I know you don't want to hear that, and I would love to sit here and say, here's my entire trading. Well, I do that pretty much every day. Here's my entire trading approach, and when A happens, do B, and when B happens, do C, and when C happens, X, Y, Z, and that's what people want. But ultimately, for you, seeing as the progression of my career and the fact that trading techniques stop working for one reason or another, it is important for you to develop something from scratch that is your own. Okay, so it is important to recognize that your trading technique is something that has to have an edge. Obviously, you cannot come in here and decide to have a risk-reward of 1-to-1 and trade something that has a 30% win rate and do 1,000 samples of it and then throw your hands up in the air and say, well, this was a trading technique and it didn't work. Well, it has to have an edge. Okay, but you can't say that my technique is better than yours. It's just something that you have to refine for yourself. Time frames. Time frames, the lost piece of the puzzle. A lot of people talk about trading. I see a lot of discussions in journals and things like that on Futures.io and others. And one of the biggest things that's missing most of the time is time frame. So I'm going to ask you the second poll question here, and I appreciate your participation. I prefer to have you participate with your answers than for me to just talk, and talk. And Kelly here is asking, so looking at price and volume is no better than throwing dice. If throwing dice is something that you've built the risk-reward into the metrics, into the statistics of a roll of your dice, then why is my volume profiling technique better than yours? It isn't. Okay, it's just math. So I'm not talking about randomness here as a technique. I'm not talking about something that doesn't have an edge at all. I'm talking about whether one or the other, works for you based on what your needs are and how your mind works and how your risk tolerance is and how you view the market. What are you comfortable with? So this has been I only see about 31% of you have voted, 33%. We're at a minute. Please vote. The question is, the question that's in front of us here is two traders are using a moving average crossover system that is built on the same 8 and 21 bar crossover, whatever that is. One is long, one is short. Who's making money? Who is making money? The two traders trading the exact same parameters, the exact same strategy. Let's call it an 8 and 21 bar crossover strategy. Okay. One is long and one is short at the exact same time. Which one is making money? Okay, so we'll close this. This has been going a while, approaching 2 minutes here. Looks like a few voters, late voters, and it is closed. Here's what you guys voted on. No idea. And that's the right answer. No idea. Because the question, a bit of a trick question, the question does not specify the time frame of these traders. If one trader is trading an 8 and 21 bar look back period system or strategy, but they're doing it on a 5-minute chart, 5-minute bar, they may be making money. The second trader may be doing it on a 15-minute bar, and they're going in the opposite direction. They may be making money as well, even though one is long, one is short. What is the point of this exercise? The point of this exercise is to tell you that when you're discussing trading, or you're talking about trading techniques with someone, or you're sharing your trading technique, it is really important to point out what the time frame is. What is your time frame? So if I sit here and with my morning trader bite and say, I'm looking long as a statement. Today, I'm going to get long. I will completely confuse people or misguide them, because my long may be a scalp right at the open, or my long could be a long position from the open, hold it to the close, and the market happened to close higher than where it opened. I'm profitable. You have lost. You've hit your daily loss limit because you got caught in the drop that happened right off the open. It just matters when you're discussing trading what time frame is in question. So any discussion of trading of any kind that doesn't include a clear definition of the time frame in question is pointless. It's just pointless. Time frame can be in the form of periodicity, meaning 5-minute, 1-minute, 2 Renko, 60-minute bars, weekly charts, but it could also be in open trade duration. So what is your planned trade duration? Yeah, I know you trade a 5-minute. I know, I trade a 60-minute, but how long are you, this trade that you're talking about opening, how long are you going to hold it for? How long? Because it makes a huge difference what time frame you're looking at and for how long you're looking. Those are huge influencers of the overall outcome of that trade. So let's move to your key task as a trader when it comes to trading technique. Okay, and again, we're on the topic of trading technique. If you happen to join us just now, we're on the topic of trading technique and where trading technique in the universe of many, many things, of probably a dozen things that we have to consider as traders to bring our entire plan and being as a professional trader together. Trading technique was the one that was chosen as the most important, and that's why we're starting this education series on this topic. Your key task as a trader when it comes to trading technique: spend your first stage of competence. Your first stage of competence doing as all do. So if you're following the same path, the normal path that most traders follow into trading, you are going to gather as much data as you can. And for that, FuturesIO and others are great resources. Books, FuturesIO, journals, many, many discussions. And that's stage one of competence. It is unconscious incompetence. You have no idea what you don't know. And so in this phase, most people go out and they just gather as much information as possible. There is no way around this except if you had a mentor or somebody you knew, not someone who alleges, but someone you knew is profitable, who will just point you to a specific approach to the market. But even then there's a disadvantage, because what works for them may not make sense for you in the long run, and also you may not form the fundamental basis of knowledge that's necessary, to keep their approach going. It's like the difference between these people that sell a system versus the people who have created the system themselves. As the market changes, you need to have the basis by which you know these are the factors that need to change. So do what everybody else does in the first stage of competence and just gather as much data as possible. You know, study as much as you want, learn as much as you want, make as many mistakes as you need to. Then spend a good portion of the next phase of your development getting rid of much of what you have learned. This is also normal. I'm not making fun of it here. This is not, I'm not being facetious. This is just part of the process. This starts you on stage 2, which is called conscious incompetence. Conscious incompetence means you are now becoming aware of the fact that you're incompetent, that you just don't know enough, that the world is much, much bigger, the universe of information is much, much bigger than you thought, that it's not a matter of just opening an account and clicking in there. Recognize that your goal is not to find the best trading strategy out there. That is where the marketing and the expos and all of that, the advertising, that's what you're being taught that you need. You need that great trading strategy that returns 80% a month. All you have to do is buy it for $5,000 or whatever. Well, if it's so good, why are you selling it? It's not to find the best trading strategy. Your goal is to find a strategy that you can really understand. So if you're working with something and you don't fully understand why it works the way it does, then you have not found your trading strategy or technique. Okay? Again, I'm going to say it. If you're working with something or following someone where you don't fully understand how and why it's working, then it is not a sustainable trading technique. Once you have a strategy that you can really understand, you'll spend the rest of your trading career, and I mean the rest of your trading career, it doesn't stop. You'll spend the rest of your trading career becoming the foremost master of that strategy. Whatever that strategy is, it is going to be it's going to be as custom to you as your worn out sneakers are custom fit for your feet. You know, you wear it in exactly for you, and it's part of the process, and you have to embrace this part of the process. It's really important. I would never feel comfortable putting on a trade based on something I don't fully understand. I just will not do that. So you'll spend the rest of your trading career mastering what it is. And so what that means, that this is your strategy, period. This becomes your strategy. Add a little bit of this, add a little bit of that, take away a little bit of this, and voila, we have something that you can actually quantify and live with and hone and adjust incrementally and so forth. This brings you into stage 3 of competence. Stage 3 of competence is conscious competence. That means you are competent, you're gaining competence, but it requires your focused, deliberate, repetitive process in order to achieve the next stage, which is stage 4, and that's unconscious competence, which means that you're able to do what you need to do without even thinking about it. Okay? And this is a process that takes a long time. Just so I can set your expectations, a lot of people end up muddling around for 5, 6, 7 years before they actually come to the point that I'm really trying to impress upon you here, that ultimately all you're doing is looking around to see what fits you. And ultimately your trading technique, the simpler it is, the more you're able to understand it, the more you're able to master it. But simplicity does not describe real life, so there has to be a small element of complexity to it, some element of flexibility to it, but overall you don't want it to be something that is crazy complex, because you have to execute on it, and you have to do so without much thought. Finally, you will know you have mastered it when the process becomes routine and almost repetitious. You want it to become monotonous. The trading day is monotonous. I'm going to come in, I'm looking for this, when this happens, this is what I do, and when that happens, my stop gets triggered, or I have a gain, and over a career of 3,000 trades, I have an edge, and that edge has gained me $1 million, so whatever that is, depending on the account size. That's what we're looking for, a daily process of coming in and repeating the same thing, which is another reason I started doing the Trader Bite, because I could not impress that idea on followers. The fact is, I come in and I do the exact same thing on those Trader Bites day after. In fact, if you start a Trader Bite without looking at the date, you'll be astounded at how similar they all sound, because I repeat the same process every day. I don't want to think about it. It's the same process every day. How do we convert this knowledge to execution and gains? This is where it all comes together. The first thing you can do, just to give you a shortcut, is study the webinar I did for Futures.io on March 29th. That webinar was called the No-Nonsense Approach from Plan to Execution. There's the Google link, a very shortened link. You can just jot it down, go look at it. I took and condensed really as much as possible what it takes. Obviously, just watching the video isn't going to do it for you. It requires you to apply what I have in there. But focus your attention on less than 5 factors, if you can, that are necessary to make a trading decision. The combination of these 5 factors triggers your trade. 5 factors is kind of the ideal, but a lot of times you have to go more than that, depending on your time frame. What the factors are has less relevance to anyone but you. Those 5 factors are really custom to you. It's like the different spice mix that makes your special, your special dish. Be absolutely fanatical about documenting your progress. It's really important to understand what the system is doing versus what it's expected to do. You can't fix it if you don't know what is wrong with it. The only way people start documenting things when they are going badly, people start documenting things when they start, and then when things go badly. And the information you need is really when things are going well, and you want to document when things are going well and then when things are going badly, and then you're comparing the statistics, the performance, your performance metrics between the time where things are going badly and things are going well. That's where the information is useful. Just because you're making money does not exempt you from keeping track of what you're doing. That's why I created the trade analyzer. Just keep storing that information, and hopefully by the end of next month you won't have to store the information. If you're part of stage 5, you'll just have it. Make changes as the markets change. This is a big part, and this is why the process has to be yours. Markets will always change. Don't make changes often, never based on someone else's profitability. So make changes as the market change. the markets change. You know, volatility picks up, you have to make a change. The market goes into balance and goes into a compressed consolidation range, you have to change. You have to change your targets. You have to reduce the expectations that you have. You might have to cut your size if volatility increases. You might have to increase your size if volatility drops dramatically. As we rally to all-time highs here, like we've been doing, you may have to trade bigger size with tighter stops. And finally, dramatic, come to terms with the fact that your profitability does not rest with your trading technique alone. Come to terms with the fact that your profitability does not rest with your trading technique alone. In my experience, your trading technique is required for there to be an edge opportunity, but it doesn't dictate your profitability. So you can have the best trading system in the world, the greatest trading system in the world, and you still can't get it to make money for you live. Why? Because your profitability is dependent on your environment. What kind of an environment have you created for yourself to trade in? The size of your investing capacity, how big of an account. You know, the trading technique is awesome, but if you only have $500 in your account and you're trying to trade the S&P or Google, it isn't going to work. The sum total of your process and habits, we are the sum total of our habits. Your habits are key. Repetitive habits. Watch athletes. Athletes warm up the exact same way. Basketball players shoot a free throw the exact same way every single time. The exact number of bounces. They receive the ball from the ref the exact same way, and they hold it the exact same way. They release the ball the exact same way. You are going to have to follow the same process. Just decide on one and tweak it over time. Your mindset is a huge part of the problem. If you're not seeing yourself make progress, are you of a fixed or growth mindset? If you're someone who believes that you don't have the capacity to do something because you were born that way, you have a fixed mindset, and it's going to be very, very difficult for you to break out of that and actually allow yourself the give yourself permission to be profitable. Your discipline, your ability to stay deliberate and focused. Spend your 10,000 hours watching, watching the market and then having, CNBC on the side and watching Game of Thrones on another monitor, and that's not deliberate practice. That is wasted time. But if you take a particular thing like cutting down on error trades or improving your execution metrics on a week-to-week basis or raising your expectancy by a tick over the next 2 weeks, those kinds of deliberate, focused, disciplined repetition, that's going to make a huge difference. It's a difference between someone who just sits at the piano and just plays the same song over and over and carelessly plays, or someone who is picking a more difficult song and working through a portion of that music sheet and doing the mistake and repeating and doing and painfully running through the process and learning that particular part to make it go from hard to easy. And finally, your understanding of risk and individual trade outcomes is very important. Understand that you cannot eliminate risk. You cannot eliminate risk. You can't skirt risk by avoiding losses. Losses are coming and they are random and they're just part of every trade. Don't try to avoid them. If you have any questions about what I just talked about, if you wish to complain or whatever, you can contact me at FuturesTrader71.com/contact, or you can email me at info@FuturesTrader71.com. And that is it. Thanks to Futures.io for sponsoring this. I guess we'll take a few questions here. I only have 10 minutes at this point, though, before I have to wrap this up. Terry, are you around?
Yep. I'm eyeballing one question first. What age did you start trading?
I started, let's see, I started when I was 29. I had a career as an engineer before that, a construction manager.
Okay. And what stage do you believe that you're in right now in your trading?
I'm probably I fluctuate between a stage 4 and I fall back to stage 3 here and there. I go through rough patches about once a year where I just can't do anything to improve the outcome of any given day.
Yeah.
I hit my daily loss limit approximately on average once a month, one day a month, where it's just I can't get anything going. And some of that is me, but a lot of it is just the fact that my edge is not in alignment with the market, and I accept it. I don't fight that.
Yeah. Let's see.
I'm glad there aren't that many questions, actually.
Okay, there's a question on why you change your technique. If you believe that trading techniques don't really matter, why or how is your trading evolved over time, I guess?
So I didn't say that the trading technique doesn't matter. What I said was that at trading you can't make an argument that one trading technique is better than another. There is no, you and I, Terry, can't sit here and argue about how your approach is inferior to mine.
Yeah.
It is a lot like religion. It is whatever you believe, whatever works for you. You want to pray to a point, and you want to pray to a tree. If that works for you and gives you peace and happiness and gives you focus and all that, then I am supportive of that. You want to trade using scalping techniques on a very expensive product, great. I don't think that would work for me, so I don't do it. So the trading techniques are important, but you can't essentially argue that one trading technique is better than another. And my trading technique changed early on because it did not work. I went from scalping high volume. You're talking about trading 4 million shares of Microsoft a day. And
wow.
when the systems took over, and this is truly market making. It's not trading in the online trader sense. This is on a dedicated line in a trading office and so on. When the market changes so that you cannot have an edge or you can't make money doing that anymore, you have to change your trading technique. How could you not? And that's why trading techniques change and evolve over time. They are relevant because your trading technique is what establishes your edge, but it has to be yours.
Yeah, I agree. I've gone through multiple revisions myself. Do you trade Globex or regular hours only?
I only trade regular trading hours. I only trade, especially in futures, I only trade when that particular future's underlying contract is trading.
Okay.
So if it's crude oil, I trade from pit open to pit close. That's my thing. That's my groove. Not saying that is the right or the wrong thing, but I'm not a fan of trading ES overnight. I would rather go and trade, the FTSE or the Euro stocks or the CAC 40 that have an underlying market. Why would I trade a market that's just moving in sympathy with those other products?
Yeah.
In fact, it's cheaper to trade those European products. So.
Okay. There is a question on a book that you mentioned earlier. What the name of that book is?
Oh, this Stadelmeyer's book.
I believe so.
Yeah, it's Stadelmeyer on the markets.
Okay.
It was his very first book. I mean, it came out. It's called Stadelmeyer on Markets: A New Approach to Trading. It is what he wrote to introduce market profiling to the world. Market profiling was developed by him under the Chicago Board of Trade, and then later Jim Dalton
yes. Yeah.
took and created his here. I'll give you the link for it. Just one second. Looks like folks are asking about the link. So the link for it here on Amazon is, well, let me see if I can find the question. Who's asked the question so I can paste it in the right spot? Well, here's Sherman. I'll post it here, and I'll
there you go.
There.
Yeah.
So take a look at that book. That's very old. There have been better books since. I would not recommend that. If you want to look at recommended books, just go to my website at FuturesTrader71.com and go to resources and then look at books here. I'm going to pull it up. So just go to resources, go to books, and then you have Mind Over Markets right here, and then Stadelmeyer on the markets right there. You can click from there. Any other questions?
Let's see. Would you say it's easier or better to trade only one time frame, i.e. day trade, swing trade, etc., and try to master it one at a time, or is it reasonable or possible to work on different time frame strategies at the same time?
So if you are, by asking that, if you're saying, hey, I like to swing trade, but I also like to scalp, it just depends on your level of competence, so to speak, what you're comfortable with. One thing I've noticed over time is that folks who trade across various products, unless they're very, very experienced, tend to not be profitable. And I watch risk all day long at stage 5 trading, and the whole point of the brokerage is to treat online traders as much as possible like prop traders. So we have alerts and stuff, and every time I hear an alert for somebody who's really having a bad time, generally when I click on their account, I see that they're trading across many different products. Trading different time frames has the same kind of effect, except it's more lenient because you're trading something that you're watching and you understand the nature of. The nature of the NASDAQ, for example, is very, very different than the nature of crude oil, even though their liquidity is about the same. They look the same, but they don't move the same way. But if you're trading crude on a 15-minute bar basis, for example, but then you want to scalp, I don't think that's as bad as trading crude and then filling your time by trading the NASDAQ. Those are completely different natured products, and I think people have a harder time making money doing that. That's just my opinion.
Okay. Okay, you talked about learning your path and how some techniques work briefly. Nowadays, the ability to reading order flow volume seems to be key in the latest trend for retail traders. What do you see to be the threat to that technique?
I'm sorry, say that again.
He's asking about that some techniques work briefly. Nowadays, the ability to read order flow / volume profile seems to be key in the latest trend. Do you see any threats to that technique of order flow volume profile?
Order flow, yes, there are all kinds of ways that the information can be hidden. But volume profiling, I cannot, I mean, I've been using this for over 10 years. And I can't tell you, I mean, you can listen to webinars that I've done when I first came online back in 2009 and listen to the ones that I've done recently, and it's essentially the same message, same approach. It hasn't changed. The fact is, at every price, there's a certain number of contracts that traded, period. Why they traded there, what was happening with the Fed, what the price of crude oil is, what gold was doing, what the euro was doing at the time is irrelevant. The fact is, the market really liked trading 21.16 quarter today. That's all I care about. It traded a lot there. It did not like trading 21.10 today, for example, or something, and there's no volume there. And then when we move back and start trading 2110 and I see that it's rejecting that price and there's still no volume there, it's telling me that the market does not see that price as fair for whatever reason. I'm not too concerned about the reasons behind it. It's just fact. It's just fact. That's what volume profiling does for me. When I look at my volume profile charts, really, I'm just looking at the facts. Here's what it's doing today. You know, it traded a fair amount. Today's profile has no consensus at all. It traded thick volume throughout the profile. What this tells me is that the market has spent most of the day looking for consensus and couldn't find it. You want to see what consensus looks like? We haven't had it for a bit, but consensus looks like that. This really fat area. It is a market that has basically accepted a certain area as, yeah, we're good. This is a fair price for buyers and sellers to interact. An unfair price would be right here. Market skips through this price, pulls back to it, unable to test it again, and continues higher. That's an unfair price. Like, that does not change, and it doesn't matter what commodity you're in or what stock you're in. I could pull up an Apple chart and show you the same exact thing. Order flow is a little bit different because order flow, there's a lot of ways to hide what your intent is, but overall, when a trade hits the market, that trade has hit the market. There's no way around it, whether you do it in an iceberg or you do it, you just lift the offer for 500 or hit the bid for 500, it doesn't matter. The volume profile chart will look exactly the same. If you fill them in with 1 lots or 100 lots, it's going to look exactly the same. With order flow, it could be 1 lots, could be 2 lots, could be 3 lots that are happening multiple times. We just don't know. So overall, it's not, I don't feel like volume profile's threatened, and I don't think it ever will be, because it's the basis of the auction, and the market is not this mathematical puzzle. The market has the simple task of bringing buyers and sellers together to trade one commodity at one exchange at one fully advertised and fair price, especially in futures. It's very difficult to control price, and that's what the market's job is. So the market is simply an auction. It's like Sotheby's, a place where you go to buy luxury paintings, and the buyers are offering their wares, and the sellers are offering their wares, and the buyers can bid as high as they want. That's a one-way auction. The market's a two-way auction, but it's the same thing. It's a known process, and so when you understand the auction itself, and the way I describe this auction is through this volume profile and how the market rotates through prices, that's something that's not likely to go away, in my opinion. I feel no need to refine my charts that much. They've looked exactly like this for a long time. There's just no need. There's no moving average. There's no anything that depends on periodicity. It is what it is. It's just everything on that chart is what it is. The mid is what it is. The VWAP is what it is, and that's about as close as a computed indicator as I use. So I don't feel the need to change it, and I think I have a huge advantage because of that. I don't have to refine this. The negative side of this is that you can't, it's very, very hard to turn this into some sort of a trading system or an automated system. It's very difficult to take this and turn it into some sort of a, with a moving average, you can pretty much any charting platform can take and optimize your data set and give you a profitable system looking backwards. With volume profiling, we're simply organizing the data, and it's not a trading system in and of itself. I know it's an elaborate answer, but it's a complete one.
Yeah, I agree. There's a question about today. In the ES, was there anything that you saw that gave you a heads up for the reversal?
So I actually, what I saw in the reversal, let me see if I can show this chart.
They asked and you had to chart up, so I figured it was a good time.
Yeah, no, I don't have a simplistic, a simple way of explaining it. But I didn't know that the reversal is likely to take place. I knew that the move up was very, very labored. So as price kept moving up, the way it was testing price higher, and I took a couple of stabs at shorts today that didn't work out. The way it was pushing higher prices was a very, very labored way, and I didn't expect it to push as high as 21.18. I expected 21.16 to trap this thing. But the first opportunity to look short was really a failed attempt. I'll show it here in the trigger chart. The first opportunity was the failed attempt at taking out the high, and then to me nothing was tradable until we pushed back into the initial balance, which is everything between these yellow lines is the initial balance zone. This was the only time I could participate on the short side, which only gave me about 4 points or so of room. I have to, full disclosure, I don't like these rally markets. This is not my kind of market. I don't like markets making new highs. The auction tends to get skewed, and it tends to be become complacent. It doesn't, for example, it doesn't pull back properly like we saw yesterday. Bigger money, a higher time frame comes in and pushes prices until it's done, and you don't get an opportunity for it to rotate back and forth towards a given target, because now you're pushing all-time highs. So I hesitate to comment on it because this isn't my kind of play.
Okay. Let's see. Okay, there's a question on what is the your story and relationship between you and Stage 5?
So Stage 5 is an independent introducing broker for futures and options on futures. My relationship with Stage 5 is that I moved from running a prop shop to kind of going online and seeing a lot of the craziness that's out there, a lot of misleading information and so on. And over time, I developed a following on Twitter and so on. And I had a good relationship with Anthony, who's the founder of Stage 5, and we decided, since I wanted to get back into a prop and he was in futures brokerage, we decided, why don't we create something that's a hybrid of both. And I saw some advantages to that. Ultimately, there are bigger plans than that simple plan for me. I intend to, hopefully, once we have all the software in place and everything in place, I intend to use Stage 5 or look at Stage 5's traders, the clients that are at Stage 5, as a place to find good traders. I won't get into that, but my relationship with Stage 5 is that I'm the risk manager here. I was part of building the firm from the ground up. Everything that is Stage 5 is something that I've touched in some way, and the whole goal of the whole vision of the brokerage really is to change how online traders are treated, how they're handled, what I understand fully what traders need in order to overcome the stuff that sinks people in the market. And I'm applying a lot of my prop experience to do that. I don't want to get into a sales pitch about Stage 5 here, so I never feel comfortable talking about it like that. But the fact is, that's what we're building, and that's what we'll continue to build. We're releasing a new website soon. We're releasing the S5 Trade Analyzer, which is a historical as well as a real-time product, on a browser-based product for CQG and for the S5 Trader. And as an independent broker, the great thing is we have access to it all. Sierra charts, if you have a Ninja license, that if you own a Ninja license before a certain date, you can be part of Stage 5. We just don't have any restrictions. We have access to a lot of things, and being independent is a big part of that. And yes, we do serve Canadian traders, certain provinces, not everybody.
Okay. I guess kind of segueing with that, why are you so open in giving with your experience and knowledge? So
it's more of a it's more of a philosophical thing. What I just don't think that. I did an interview with traders a while back, and I laid out why, in detail, why I was doing this. And to me, it's a legacy thing. It really is. And I don't want to repeat the whole thing, but we're here, we take up form, and we go through the process of being here. And in general, if you're not doing something to improve the situation, like I do for my kids, I've got 2 kids, and that's really what got me going on this. 2 kids in a process of getting divorced, really, if you want to hear about the personal side. I just recognized that there's so much more to me sitting here and clicking in the markets all day. It was more important for me to just create a community and to just help something happen. What does it cost me to do this? I love trading. This is ever since the first day I watched someone trade in Vero Beach, Florida, when I visited a friend and watched what he did. From that first day onwards, I love this. And if I can affect just one person after all these years and help them kind of move from getting lost, jumping from one system to another, one product to another, to actually being an independent person who's able to sustain himself, his family, or whatever, herself, then I've done something, that I've affected something. That's really it. What does it cost me? Does it interfere with my ability to get in and out of the market? No way. I mean, the products I trade are liquid enough. The method I trade is constantly evolving. I'm not scared to talk about what I'm doing, and I talk about it quite openly, you know, in the public and in the chat room and so on. Ultimately, in my experience, you're just not going to make money copying someone. You can't copy me, and I can't copy you. So if we can't copy each other, and there are many, many prices and many, many seconds to get in and out of the market, then what does it cost me? Now, if we are talking about trading systems, you're not going to hear much from me because I have to protect that formula because I don't want to degrade my system's performance. But I'm not trading with a trading system. I'm a discretionary but very, very systematic trader in my approach to the market, very process-based trader. So there's nothing for me to lose and a lot to gain, right? So ultimately you will leave this world, and what you leave behind is what matters, and that's what it is to me. And there's also a business side to this. You know, people have to have a broker. People are going to go pay a broker. Why not be a part of a community where you can benefit? We can benefit each other. I'm just being honest. I mean, I know that doesn't sound very marketing wise, but that's just the truth.
Okay. I guess I'm going to pick this last question, and we'll leave it with this.
Yes.
If you started futures trading today as a beginner, knowing what you know, which resource would you use first and how?
I would probably use the same. I would probably undergo the same process, except I would try to shortcut your learning curve by telling you to not get lost in the mathematics and the graphics of trading. To understand the auction, just go and grab a book that talks about profiling. Go look at the videos on my website, the free ones in the video archive. Just understand what makes the market move. Why does the market uptick, downtick, and so on. Then layer in your moving averages and your trend lines and your channels and your patterns and whatever else. I think had I done that, I would have saved myself a lot of time. The other thing is, don't trade live until you're really ready. Make sure you have a positive expectancy before you put your money on the line. And then finally, once you do trade live, your entire outcome, the entire outcome depends on your ability to change how you view things that make you scared. Trading with a scared mind is a very, very it skews the reality. When you're afraid of losing and you're trying to do whatever you can to avoid a loss, it skews the reality of what you see. You will only see what you're afraid of in the markets. You're long, everything says get long, it's a trend up day, it looks great, you got a good price, but then there's a huge offer in the book and you're afraid of losing, and you just go and take a one-tick winner and the market goes 12 points for you. Don't tinker with it. Just let the statistics, let your plan flow. And understand that when you're in a trade, you're not in a good position to make management decisions on that trade. I wish I'd known that early on. I would get into trades and I would think that because I'm in a trade, I'm much, much smarter and I'm able to read the market better, when actually, once I'm in a trade, I am the dumbest fool in the world, because I am driven by avoiding a loss, and that has no edge whatsoever. It just slowed down my progress.
I relate with that because I was the same way. Once I finally got to the point of just letting a trade work to whatever the outcome I had originally decided when I first put the trade on, that's whenever things started really turning.
Yeah, and think about it this way, by the way, just to add to that. You spend all this time studying stuff, you spend all this time doing homework, you spend all this time setting up and paying for equipment and putting your money in an account, and then you throw it all away by just fiddling with the market once you put a trade on. Like, all the work you did before it was for nothing.
Yep.
When you're sitting there and interfering with the trades all the time.
Yep, I agree. There's a question about a Google link that you posted earlier in the slide. I tried it. It's not working. It appears that it's case sensitive.
It is case sensitive. Is it this link here?
I believe
it is very much case sensitive, and I can post it. Is for?
Yeah, that's the link.
Yeah, this is for. You can find this on my website. Just go to FuturesTrader71.com and just do a search for no nonsense approach. This is the page it takes you to. You can find it in there. So, and then the YouTube link, you can just go to youtube.com, do a search for FuturesTrader71, hit subscribe, and in the morning you'll get notification when I release the live stream link. Also, the easier way to do it is just to follow me on Twitter, twitter.com/FuturesTrader71, and you'll get notice. You'll see the link to the Trader Bites in the morning if you want to get to the YouTube channel. Anyway, that's the time we have, I think, right?
Yeah. Can you just throw up your contact info again, and we'll leave them with that, so if they want to email you questions or anything?
Yep, right there. FuturesTrader71.com/contact or info@FuturesTrader71.com. Someone will get back to you with whatever you need.
All right, sounds good. Thank you for your time today. It was a great webinar, and I look forward to the next one.
Thanks a lot, man. Take it easy.
All right, you too.